following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope all of our listeners out there are faring well and indeed thriving in these markets, these up and down and uproarious markets that we're having these days. Of course, as I say that, we're recording on a Friday afternoon, and it's not quite uproarious right now. The S&P's up 3 handles, the Dow's up about 12, and the VIX Cash is down about 2. So we're having a unprecedented quiet day. I think everyone's keeping their powder dry ahead of what the Fed has to say this afternoon, and waiting for that Bernanke put to see if that comes into play or not. And of course, as always, I am joined by my faithful companion, the yin to my yang, Mr. Don Schlesinger from the Volatility Exchange. Don, welcome back to the show. How are you doing this fine Friday afternoon?
Very good. We're gearing up for this big hurricane, as listeners certainly know. Kind of remarkable to think that of all places in the country, New York would have not only an earthquake, but a potentially huge hurricane all in the same week. It's kind of weird.
When it rains, it pours. And my parents are in town. I'm from Connecticut, and we were discussing actually this hurricane and the fact that the last time we had a real significant hurricane in Connecticut was Gloria, and that was back in early 80s, I believe. So it's been quite a while since that area has really been hit by anything substantial in terms of a hurricane. So.
Well, we're gearing up for the potential to lose power and have lots of trees down and stuff like that. So we'll see what path it takes, but this one promises to be an interesting weekend.
Hopefully the Schlesinger estate emerges unscathed. So just bring in get some canned foods and water, bottled water, and bring some board games, and you'll ride it out, and you'll be all set.
There you go.
All right. And with that, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the program where we discuss what happened, what's been going on, what's been lighting up the tape in the world of volatility for the past week. And we're going to kick things off with our volatility pit reporter, good old Mark Sebastian from OptionPit.com. Mr. Sebastian, Mr. Seabass, what did you see in your volatility review for the past week, or in your case, a truncated week, but the most of the week nonetheless?
We decided to record this on Thursday because I demanded to get to. I wanted to prognosticate about Ben Bernanke.
Yeah, about Bernanke ahead of time, of course.
Yeah, I insisted. I didn't want that knowledge. Yeah, I'm still. We've had this big run up the last couple of days. The VIX closed near 40 today. We haven't had a lot of movement, and I think there's pretty big expectations leading in tomorrow that there's going to be some sort of major movement, and I just don't see it happening. I did have a student point out kind of last year, the Jackson Hole Conference, the market shot up about 2% and then just kind of took off from there, starting at 1,100 and running up all the way up past 1,300 with only a small little break in there. And one, I don't see it as the same thing. And two, I just don't see how this is anything that can really help us that much. Everybody's seen what QE2 did. I don't see why you see it as the benefit other than as a short-term trade. So my whole thing this week, if you get past some of the magnitude of the moves, we really only had a range of about $50, and we've got a VIX of 40. I don't think that cuts the mustard. My thoughts is that I think vol's overpriced, and by maybe even Labor Day, we see VIX falling below 30. That's kind of my thought. That's my prediction. You and I are going to be talking next week and saying the VIX is at at 29, 28.
Yeah, maybe. I don't know if it'll happen that fast, but it will be coming down the road. I tend to agree with what the VIX futures are pricing in, that, get out of the way in the short term and the long term, prepare for a nice, gentle move to the downside in VIX, maybe a little more gentle than 10 handles in a week. But we've seen crazier things happen in VIX. And, of course, with Bernanke getting in the mix tomorrow, we've discussed on other shows whether how much of that is built into the market, how much fluff they're building in around that Bernanke address tomorrow. Maybe it's a good time to put on some limited risk short ATM spreads in SPX and stuff to capture some of that fluff, and then obviously you hedge the wings in case the market goes crazy, and then you close it out before the close so we don't have the crazy weekend risk that we've had of late. But it might be a good way to capture some of that Bernanke fluff and put that in your pocket, because I think a lot of us agree that what can this guy really do at this point that is substantive and not just, like you said, a short-term day trader's bump to the market, but not really long-term additive.
Right. I agree.
All right. Thank you for that, sir. And of course, we do cover the broad spectrum of volatility products here on Volatility Views, and that includes the world of Eurovol and everyone's favorite, the VolContracts. So, Don, what's been lighting up the tape out there in the land of Eurovol?
Well, I finally got something right. I guess even a blind pig finds an
you've hit a few predictions now on increased volatility out there in Euro.
So about a week ago, when we had our segment at the close, which we call the crystal ball, I commented that although the previous night's settlement of the front month 1 vol or 1 month realized volatility September contract was 1150, the partial vol, which was the actual logged data points for realized volatility, was actually in the mid-9s for the handle, and that Robert Engel at the Volatility Institute was predicting an expiration vol in the low 10s, and yet the contract was trading at 1150 or so. So I went out on a fairly safe limb, I thought, in suggesting that we'd probably see lower action in the week or so to come. And here we are with last night's settlement down almost 2 full handles at 955, and a current market with an actual handle in the 8s as a bid as we're on the air right now, so down about another 30 cents today. At this point, we actually have another interesting phenomenon. We have the simultaneous expiration of both the 1 month product and the 3 month, the 3 vol for September, each with 10 days to go to the impending expiration. And we've talked about this in the past. We have the partial volatility, that's the realized volatility that's already taken place. And then we have what we're calling the inferred volatility, what's left for the 10 days remaining, such that when you put the two together, you get the price at which the contracts are trading. And although there isn't a great deal of liquidity to do any of these things in size, what's interesting is when these two get a little bit out of whack, and yet they're forecasting the same remaining 10 days. So we have inferred volatility for the 1 month contract, which is at 1091, whereas it's at 1287 for the 3 month. And of course, they can't both be right. It's as if two contracts predicting the same 10 days remaining volatility have two very different viewpoints. So that would lead you to believe that perhaps one of them is inflated or one of them is too low, but that they would probably be coming in line. So that'll be something to watch as the week plays out.
Has that ever happened before, that much of a discrepancy between the closing 3 month and the 1 month?
It's almost two handles, and it's kind of interesting simply because although in the case of the three vol, all it really is saying is that last night's settlement was about 25 cents or so higher than what was already logged, but because 59 data points have been in the formula already with only 10 to go, it would take 12.87 volatility over the next 10 days to allow the contract to actually settle at the price that it settled at last night. So although the 23 cents doesn't seem like much, it actually implies, and we can infer from the price, that you'd have to have almost 13 volatility over the next 10 days for it to close where it closed last night, or for it to expire where it closed last night. And you do the same analysis for the 1 month, and you get very different numbers. So that's something to look at. Final point that I would make: each expiration we kind of put up on our website for people who enjoy the action and the volatility of a volatility contract, particularly the 1 month, that we've seen in every contract that we've had, peak to trough or vice versa, moves of in excess of 20, sometimes 30% in every one since we listed our first product back on February the 7th. And this September, 1 vol is no different. The peak was 14.24, and the trough was actually a last night's settlement at 9.55, and that actually represents a movement of almost 33%. So if you're looking for volatility, you can find it in volatility contracts.
Yes, as we said before, these products tend to be a roller coaster ride, and a lot of people are migrating to various products like corn these days in the hunt for that ever elusive product with a lot of volatility and a lot of liquidity. And so maybe the vol contract should be on their horizon as well as the liquidity increases. But I think it's really interesting what you mentioned about the 3 month versus the 1 month and the discrepancy there. It sounds to me like there is some spreading to do between those two contracts.
Yeah, it almost makes me itchy to get back on the trading desk, but I'm not allowed to trade these things, so we'll just pass it along to others to look at.
That's an interesting one. I like that one. Maybe we'll have to, our listeners should definitely explore that one before they expire. All right, with that interesting tidbit, we're going to close out our volatility review segment and roll into our off-delayed, but finally here, our mailbag segment.
Listener mail. Listeners write in.
Mail's in.
Mailbox.
All right, and welcome to the mailbag. And this is, of course, the portion of the show where Don and I peer into the murky depths of the mailbag that hasn't been opened in a while, so it's a little musty. And we apologize, listeners. We've been so busy with such a fabulous array of guests on the program that we haven't had time to get to your questions, although Don has been doing an admirable job, I must say, of keeping the forums well in hand and responding to people very rapidly there. So if you do have a question, Don seems to get to them relatively quickly on the forums, but we have quite a few to discuss. And we're going to kick things off with a question from our forum, and it comes from one of our old friends, Jersey Boy, in the forum, and the title of his thread is Gamma Hedging and Market Crashes. He writes, Mark and his faithful sidekick Don, and I dispute that. Don is not my sidekick. Don is indeed the yin to my yang. Don is the very essence of this program. And he also writes, love the show. I've been listening since episode 1. Glad to see that there is a new feed in iTunes to drive more listeners, and indeed that is the case, listeners. So if you have been searching in the past for volatility views in iTunes, it's been a little hard to find. You had to find it in our Options Insider main network feed. It was kind of buried in there. Now it's indeed also listed as its own show, so you can find it either way. You can continue subscribing to the network. You can also subscribe to the individual feed, so that should make things a lot easier going forward for people looking to find the show. And he continues, I have an interesting thought question for both of you. It's not specific to volatility, but I thought I would pick your brains on it nonetheless. My question has to do with the correlation between recent market crashes and gamma scalping. Several friends of mine have posited that gamma scalping / hedging may have been the cause of, or indeed a catalyst for, the recent massive down days in the market. I disagreed with them, but I thought I would reach out to the two of you since you are the experts in all things options. And I don't know about that, but we will try nonetheless. He continues, "Can you settle this debate for me? There's a steak dinner in it for me if I'm right." Well, Jersey Boy will endeavor.
What's in it for us, Mark?
Yeah, I know. We need to get it. You send us some frozen Omaha steaks or something. Maybe a nice bottle of Cabernet or something for our efforts. Or at least a picture of you enjoying that juicy steak. But this is actually an interesting question. It seems to pop up every now and then, and with the recent swings in the market, I've heard a few people mention it again. I actually had a call with someone the other day who was discussing a topic similar to this. And, when you first hear it, I think as your knee-jerk reaction is to say that's crazy. Gamma is pretty much a self-canceling event. It's not really going to cause crashes like this. But then as you mull it over a little bit, you start to think about the disparate way gamma is employed in the marketplace, particularly on the downside spectrum of the volatility skew. Because if you think about these days, and the days I'm sure he's referring to are these massive, 400 or 500 point down days we've been seeing lately, and those are kind of aberrant situations or aberrant scenarios, but they do tend to move us significantly down the skew curve and into the put wing, where a predominant, I'd say the vast majority of market makers tend to be short. Hence, that's why the volatility skew is inflated down there, because retail buys puts and customers buy puts, and market makers tend to be net short those quite often, and they have to use delta hedging and other ways to offset that. But as we start going in these massive, massive down days, we're blowing through many strikes, and quite frankly, most market makers tend to prolong their negative gamma scalps as long as possible. But on days like that, you can't really avoid the pain. Eventually, your risk manager is going to make you hedge that negative gamma. So there will be some downside selling from the market makers. And the question comes to me, actually, as I was thinking about it, is does the negative gamma that comes from the professionals, the liquidity providers, and their scalping activity, does that supersede, or indeed is there just more of it than there is on the retail and customer side? Because you think of customers and who are the ones who are predominantly buying the units, these puts on the downside, they tend to be not be cognizant of gamma for the most part, and they're not really scalping their long gamma. Maybe some of the significant and large institutional customers who are a little more savvy are doing that, but the vast majority of them are buying puts to protect long equity positions. They're not in there scalping their long gamma on a regular basis. They have a position they've established, and that's pretty much it. Whereas the market makers are hedging their negative gamma on extreme downside days. So that's the only way I really think it could possibly come into effect, is on those extreme days, perhaps, and I say this perhaps because there really is no data on this, but perhaps it could exacerbate a 400 plus down day in the Dow and make it into a 500 plus down day, or maybe a 45, 50 handle S&P day into a 50 plus handle S&P day. And perhaps that contributes to some of these late day extreme movements we've been seeing in the market on these significant down days, where all of a sudden we drop another 10 handles towards the end of the day, or vice versa. It's just it could potentially be these extreme gamma scalps and extreme gamma hedges, and market makers holding out until the last minute to try to hedge to avoid hedging their gamma. I think it's an interesting thought question, like Jersey says. Like I said, there is no data on this. I'd be curious to hear your opinion as well, Don. But that's kind of where I fall down on it. I think it's probably a non-issue, but in some of these extreme cases, it has the potential to exacerbate an extreme sell-off. What do you think, Don?
I think that's a really good and comprehensive answer, and I answered on the website kind of one half of your answer, saying that sometimes retail and even hedge fund managers or portfolio managers kind of try to lock the barn door after the horse is already out, and in days of these extreme movements when they really get spooked and look at the puts, that, as you correctly mentioned, would not be under the heading, if you will, of gamma scalping or trading, movement of deltas. That would be, everybody kind of running for the door all at once and realizing that, gee, I wish I had had some of those protective puts in place a lot earlier before the event took place. And so they go out and buy these puts. And of course, that's not what drives the market lower, but the immediate action or reaction to an influx of orders to buy puts is that obviously somebody is selling those puts, and selling puts then creates a delta long position. And those market makers and people who are providing the liquidity now have to get neutral. They certainly don't want to be long in that situation. So they're the ones who then drive the market lower. The impetus is the put buyers, but the actual action is the hedging of the short puts by, selling futures or stock or whatever it is that's going to offset that position. The other half that you covered very nicely is that these professional market makers who provide liquidity by selling options, both puts and calls, have these balanced delta neutral straddles on. And of course, when you are short gamma or short volatility in that fashion, you're in the unenviable position that in order to make your adjustments, you're always buying high and selling low. The story of my life, as I used to like to kid, because I was short so often. So
yeah, that's true. I don't think you ever had did you ever have a positive gamma position once in your trading days, Don?
Well, not if I could help it. I used to say you could count them on the fingers of one hand and still have several fingers left over, is the way I usually expressed it. But so that's the situation here. They're adjusting, but they're adjusting, unfortunately, to having to sell as the market itself is selling off rapidly, and surely that could exacerbate the problem. So the true question is, does one predominate? Does one dominate the other? And frankly, I don't know if there is such data or if there is a good answer. So I don't know if we have won Jersey boy his stake or not.
Yeah, we seem to be in the non-committal camp on this one. I think we're leaning towards no, but with the potential for, on these extreme days, it could exacerbate an already significant move. It's not going to cause it. You're not going to go from an unchanged day to down 50 handles in the S&P due to gamma. That doesn't work that way.
Right, and that I agree with that. So if we can fight for Jersey boy's stake, I would say the same thing. This activity is not going to precipitate for any reason these kind of moves. Once we're in them, it's possible that they could exacerbate, but that may not be the exact spirit of his question. So we'll struggle to get you that steak any way we can.
Yeah, maybe instead of a steak, maybe he'll end up getting a nice hearty burger from us for this.
At least a burger,
yeah,
right? Yeah,
Jersey, write in and let us know how you fare on this. If you do get a nice steak, or if you do maybe a pot pie or something along those lines. But it's an interesting question, and in these types of markets, it's one that's interesting to ponder. There really is no data. Maybe it'd be nice to see some academics go out there and dive into this. I have no idea how you could possibly isolate the gamma hedges of prop shops and market making firms, because they tend not to really release that data. They tend to keep it pretty close to the vest. But
it's a little bit similar. I remember all the way back, I wrote a short piece called "Don't Shoot the Messenger," and you had Hans Stoll from Vanderbilt, who wrote a seminal paper after the crash of '87, when everybody wanted to blame the index arbitrageurs and the program traders, which I was also involved in, for the crash. And I tried to point out that in that particular instance, we actually were the other way. When the futures dislocated from the cash and were 20 handles below, if there was any opportunity there at all, it was to buy the futures that were underwater, and do the arbitrage to sell the cash, so that basically we weren't the ones who were accelerating the problem. We were probably going in the other direction, which would be the case if it were the straddle buyers who who represented the professionals here, or were the prevailing position, where when the adjustments are made, you're doing it in the way you'd like to do it, which is buy low and sell high. So we were sort of saying, hey, look, don't blame us for this.
It's amazing, even 20 odd years later, how much that rumor still gets around that the 87 crash started in the bowels of the S&P Pit here in Chicago. And I still hear that one pop up every now and then, and it's surprising that it has such long legs. I think a lot of that is just due to the ignorance of derivatives in a large part of the financial community. Oh, it had to start out there in those derivative pitch. Those are just shady places.
Gotta blame somebody.
Yeah, exactly. You gotta blame somebody. Why not the Chicago boys? All right, next question. I didn't grab the person's handle, but his initials are ZPF. And this is another question from our forum, and the title of the thread is An Obvious Question for Don on the CBOE VT/VA contracts. And he writes, I have been a long-time listener to the Volatility Views program and find your opinions are well-reasoned and supported. So, Don, you have a fan, sir.
Just setting me up for failure here, but we'll see what we can do.
I await the day Volex floats an S&P 500 variance contract to provide a more reasonable volatility hedge than VIX. Don, did your mother write this? Tell us the truth.
First of all, you got to say, bite your tongue, because it's not a variance contract; it's a volatility contract. But we'll get into that.
We'll parse his words later. But he continues. However, I have only two questions. The CBOE has had S&P 500 variance contracts available since 2004. Why have the VT and VA never taken off? And how does VIX remain the volatility hedge of choice with all of its quirks? I look forward to your response. So, Don, since this was addressed to you, I shall throw the ball in your court, sir.
I'll have to try to live up to my well-reasoned response that is supported. So we'll take the two questions in turn. I may have commented once or twice about these variance futures that CBOE tried to float and that have not met with great success. And we may have discussed it quite a while back, so it certainly bears repeating. Most of our listeners know that variance mathematically is the square of volatility. So as such, it's a bigger number. So if you have 20% volatility, the variance is 20 squared, or 400. And on days when things go a little crazy, like the days we've been talking about, and you start to see implied volatilities and even realized jumping up into the 50s and 60s, if not to mention the 80s and 90s that has happened on occasion, that would imply variances when you square those numbers of 4, 5, 6, even, like 7,000, okay? And so one of the terrible problems with variance is that the margin calls and the initial performance bond or margin for a single such contract can be really daunting, and the maintenance margin on a day when you have these kinds of moves can be absolutely frightening, so that I can't really think of too many entities apart from the biggest and the most flushed of the investment banks that would be able to trade something like this on any kind of regular basis. It certainly is completely out of hand for any kind of retail client. And there are other problems with variance. It's not a linear function like volatility, so it's a little bit harder to understand if you have, just to take numbers that are small and simple, if you have a volatility contract and the volatility is 10, well, then if it goes up 1, you make 1 point, and if it goes down 1, you lose 1 point, and the contract has a multiplier, and it's linear. Variance doesn't work that way, and some people are uncomfortable with it. If you have 10, then the variance is 100 or 10 squared. Now, if volatility goes up 1 point to 11, Now you're at 121. Well, you've gone up 21. But if you go down 1 to 9 and you square 9, you're at 81 compared to 100 is 19. So that linear movement in volatility where you're indifferent as to whether it's 1 point up or 1 point down, here the variance has, you gain 21 to the upside, you only lose 19 to the downside. So it's a slightly different creature and, just even more complicated and harder to explain to people. So between the getting used to variance as opposed to volatility and the onerous margin requirements that could befall somebody who tries to trade these on these crazy days, the product just simply isn't terribly appealing. And so that's the reason for its lack of success. The second part of the question, as I recall it, is how does VIX remain, or why is it the volatility hedge of choice with all of its quirks? And I would answer that until we're going to try to make a run at VIX with a full array and a full complement of realized volatility products on many of the major assets, which again is surely in the works and hopefully will come to fruition in the months ahead of us. VIX really is the only game in town. And so volatility swaps and variance swaps, over-the-counter products are really, again, not in the cards for most investors and most traders. Again, it's the big boys who trade realized volatility that way. So you've got the very great success of VIX, not only as an institutional product, but especially as a retail product. And right now, at least on one asset, the S&P 500, it's the only game in town. So yes, with all of its quirks, with all of its drawbacks, with all of its shortcomings, it's kind of that or really nothing else. And all we can keep saying is stay tuned. We hope to change that in the weeks and months ahead.
And listeners, I would just remind you too, this is kind of a topic we've discussed in the past, just the general as a whole lack of success of pretty much most, if not all, of the products that the exchanges have listed in an attempt to steal the business away from the OTC cabal. If you recall, Don, in the wake of the 08-09 meltdown, everyone thought all of this OTC business was going to migrate to the exchanges, and it just has not been the case. The OTC cabal is a powerful and very protectionist entity, and they don't let their business go without a fight. And even though many of those firms have vanished in the wake or been gobbled up in the wake of the 08-09 meltdown, still they are a powerful entity. And when you control the volume and the paper flow in a product, why would you share that with the exchanges? So I think a lot of these OTC contracts have suffered because of this. The exchanges have tried, or OTC contracts being copied and duplicated on the exchanges have suffered because of that. Just the cabal wants no part of them and actively fights against any business for those, and that tends to hurt them. Look at the exchanges' attempts to list credit default swap contracts years ago. Those withered and died on the vine. And there are also inherent problems with the VIX with the variance contract itself that tend to on the CBOE that tend to cause it as well. And I'd say, listeners, if you are interested in some precise reasons why the variance contract over at CBOE hasn't exactly taken off with the OTC crowd, I'd encourage you to listen to our episode 83 of our Options Insider radio program, where I actually sat down with Jay Cowie from the CBOE Futures Exchange to discuss this exact issue. And I asked him point blank, why haven't these contracts really taken off the way a lot of people expected? And we have an interesting and frank discussion about that. So you can go over to our website, theoptionsinsider.com, or you can find it in our main feed there in iTunes and listen to that for yourself, as well as some reasons why the variance contracts have yet to really light up the tape, in addition to all the reasons that Don just outlined. Oh, before we go, I did find the handle for the user who posted that question, and my German pronunciation is not as what it used to be, but I believe it says Fischmonger, which I assume is German for fishmonger. So I like this. I like that handle. That's a good one. But yes, and since we are on the VIX tip, we might as well continue with an email we received from Glenn Safworth in Austin, Texas. And he writes, "How would you improve the VIX? Dear Mark and Don, I'm interested in your perspective on VIX as a product. You've discussed the product numerous times in the past. Now that the product is close to 7 years old, it's getting somewhat long in the tooth. If you were to revise the VIX, what changes would you make, aside from switching it to realized vol, of course?" And I think he's alluding to what your obvious change would be, Don. But I'll start off here. I think, obviously, a lot of the feedback and a lot of the issues we see with the VIX these days tend to focus around the settlement. The settlement process is just wacky, I think is the best way to describe it. These contracts can settle outside of their trading range for the day, and a lot of other things that have to do with some of the quirks in the formula that they've established for the VIX. And one of those quirks, I think, has been ameliorated somewhat over the past few years, but it's still an issue, is the fact that the VIX calculation, when they revised it, which is actually a good move at the time, or at least it seemed like a good move, was to take into account the skew of the S&P 500, not just the at-the-money volatility. So they incorporate the wings into the calculation, and they do that by incorporating pretty much any strike that has a bid. And those strikes that have bids and are essentially worked into the formula. And it makes a lot of sense on paper. What we saw in practice, though, are people coming into the product around settlement time and putting bids in not just out-of-the-money puts, but far, far out-of-the-money puts. Well, many, many dozens, if not hundreds, of handles beyond the last strike with any relevance for expiration, and they're putting bids in these things because they've calculated out which exact strikes they can put a small bid in to adjust the settlement just enough to make their contracts pay off. And so that's gone back and forth with the discussion of the manipulation of VIX settlement, and those trades still go up. They're not as effective as they once were. I think people have figured out how to countermand those, but still, I think some sort of adjustment to the formula to make those types of ridiculous out-of-the-money, both in percentage and from a volatility perspective, bids less weighted perhaps or even discounted in the overall formula, I think would help with the relevance of the settlement. But yes, all of the improvements I would have to do would generally be around the settlement process itself. And Don, aside from making it a realized vol contract, what would you like to see from the VIX?
Well, it's a really tough dilemma for me because I would prefer not to suggest to those who control the branding and the dissemination of VIX how they can make this product even better when of course we're trying to come out with a product that we think is better from the inception, just conceptually. But what you said is certainly true. People are unhappy with the prospect that settlement could potentially be manipulated, and it's something that often has been brought up. One of the things that I have as a philosophy in life in general that I would just wax philosophical for a moment here, if people will permit me, is it's a lot harder to fix a problem once it has developed than it is to try to foresee what a problem will be and to avoid it in the first place. And I'll sidestep the answer somewhat here by saying what we've been saying all along with realized volatility products, and that is that from a conceptual point of view, I think that trying to afford the public a way to trade volatility, that the entire concept of using implied and having this terribly arcane and difficult calculation to understand, and incorporating all of the strikes and being able to manipulate prices and having it settle to yet another forecast as opposed to anything that's calculated is just simply not the best way to go about it. So I don't have a fix for the VIX, and I just hope that one day the public will consider an alternative way of trading volatility, and that we can offer a product that's both easier to understand and perhaps more efficient in the way it operates.
Well said, sir, and very political. I like it. But yeah, I think one of the things I was alluding to, of course, is that special opening quotation, which they use to determine the settlement prices for VIX, and that is driven essentially by the supply and demand that you see on those bid-ask spreads in the old SPX. So if that's that whole process needs to be reworked so that supply and demand in these far out of the money contracts, particularly the put contracts, isn't allowed to skew the settlement process as it seems to be doing these days. All right, and with the VIX question out of the way, we'll move on to a question/comment from our old friend Complete Beginner in the forums, and his title of his thread, I like the title, it is Volatility Views Has Great Guests. I think you and I can both agree on that, Don.
Yep, we've been very fortunate. I hope we can continue.
Now he writes, I wanted to post in this forum to let you know that I've really appreciated the guests you've brought on the program. Volatility Views is really in a class all its own when it comes to the quality of your Volatility Viewpoint segment. I'm eagerly looking forward to more guests. Who do you have on tap for future shows? Also, thanks for adding a new podcast feed in iTunes. It makes it much easier for me to find the show and also to recommend it to my friends. Vega Forever, Complete Beginner. I like that closing. I might have to end all of my correspondence henceforth with that salutation there, Vega Forever. But Don, that's an interesting question. We have had some great guests. We've been very fortunate here.
And August tends to slow down just a little bit as people are on vacation, and yet we've managed to keep the trend of our interesting guests even through the summer months. And we actually have invitations out to two people. I'm going to decline to mention their names right now because we'll wait to see if they accept our invitation and do come on the show. But we're trying very hard to stay ahead and keep interesting people in the pipeline. We also have standing invitations out to people who have been extremely well received in their spots on the show. One as recently as just last week with Ewan Sinclair. He's very bright. He's very interesting. Certainly like to hear more of what he has to say, and he has a standing invitation to come back. The same is true, of course, for Professor Robert Engel at the Volatility Institute. We had a great show with him. Surely we could have others. And so we not only look forward to new guests, but perhaps repeat visits from some of the ones who really were quite fascinating to chat with.
Maybe we can bring some of them back for the Great Skew Spectacular that we have planned, where we can dive into all of the nuances and quirks that have created the volatility skew that we all know and love and or hate. And I'm trying to, as I read this question again, Dom, I'm trying to reason out in my mind if it's indeed a compliment or a slam for you and I, because he's saying he loves the volatility viewpoint segment. That's in a class all of its own. He doesn't say the rest of it. He said that maybe you and I are we're garbage, but the viewpoint segment is fantastic. Well, nonetheless, we will take your comments, Complete Beginner, as a compliment. And actually, they are. I'm just teasing you. And thanks for that. And also, like you said, you do also note the feed in iTunes. That was a recent addition for us. And as I mentioned earlier, you can now search for it, this show, on its own in iTunes, which will make it much easier, as Complete Beginner says, to recommend it to your friends. So by all means, go out and recommend it to all your friends who are interested in volatility and volatility trading. And as the hour is growing late, we do have to close up the old mailbag for this show, but don't worry, we'll be opening it again in future shows. We'll try not to go as long next time between mailbag segments, but in the meantime, you can always count on Don and occasionally myself surfing into the old forum and answering your questions there. Of course, you can always shoot us emails as, what was his name, as good old Glenn did from Austin. You can shoot them to questions@theoptionsinsider.com or over to Don at info@volex.us. Just make sure you put volatility views in the subject line so Don knows what those questions are for him. Of course, you can reach out to us via Twitter, twitter.com/options or twitter.com/volex_info, and of course, Facebook Options Insider, or search for Options Insider, or search for Volatility Exchange on Facebook. You will find us there. And of course, the ever popular, I think ever intimidating, because very, very few people seem to use it, the Options Insider Net Radio Network voicemail box, 312-544-9356. Leave us a pithy question, and we shall play it on the air. And with that said, we're going to close out the old mailbag for this week and roll right into our crystal ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. This is, of course, the portion of the show where Mark and Don and I tend to prognosticate wildly, and of course, our prognostications will be a little bit crimped this week, given that we are recording ahead of the big Bernanke speech tomorrow, so we don't really know what's going to happen going forward for the next week. But that in place, obviously, we've discussed some longer-term potential trends in the VIX. And good old Mr. Mark Sebastian, our volatility pit reporter, tends to think that VIX is trending downward in the long term. I tend to fall on that train as well. Bernanke aside, what else are you positioning for in terms of volatility, Mr. Sebastian?
Well, I think that we're in a position where, I see the I see the VIX in a situation where it's heading down, maybe not just trending down, but really moving down. And, that's something that I really strongly think could turn into I'd be shocked if we're not below 30. And I think we're going to see some sort of resolution out of Europe in the near term. But in the short term, GDP is going to probably not be great this week. And I actually think unemployment next week may actually be better than we expect.
So you think that'll be accompanied by a commensurate explosion to the upside then in the broad markets? You think we'll be able to hover around these levels and the VIX will continue to drift south?
For now, we're stuck between 1120 and 1200. The real resistance point is closer to 1250, because that's really where a lot of these guys are stuck long, that we're buying futures, waiting for that 1250 bounce the last time.
Yes, I suppose a 100 handle rally or thereabouts in the SPOOs could be enough to knock us below 30, certainly. All right, and thank you for that, sir. And of course, we do speculate beyond the world of S&P volatility here, even as far out as to the world of Eurovol. And we discussed in the opening segment there, the volatility review segment, the very interesting divergence between that 3-month and that 1-month contract out there on Volex. And I would be curious myself to take a look at those, and I would go out on a limb to predict some sort of convergence there. I don't know how far it will converge, but there must be, you would assume, some degree of convergence, so there seems to be some potential for trading there. Don, is that your prognostication as well?
Yeah, I think it's kind of a mathematical game that listeners might play, and it might be more theoretical in nature than practice, given the size of the current markets and the bid-offer spread and where you can trade with respect to a static settlement price that's on the screen from last night. But I think it's interesting nonetheless for listeners to go to our website at volex.us, and in the pull-down menu, just go to Data and then VolX Series, and take a look at the current contracts as they're trading, where you will see a settlement price. You'll see the partial volatility, which has already been logged. You'll see what the inferred volatility is from the settlement price and the piece that's already been calculated. And then you'll see what we're calling the G-vol. And the G-vol is this forecast of the expiration volatility based on a modified Garch model from Robert Engel and the Volatility Institute. And you can play with the numbers, and we're coming back to the point that I made earlier. Right now, there'd be the indication for a trade of probably selling the September 3 vol or 3-month contract and buying the 1 month, but there's also a ratio involved, and so you have to work out the numbers. I think it may come to about 2.5 of the 3-month for every 1 of the 1 month, because the sensitivity of the 3-month, since it's logged so many more days, is not the same as that of the 1 month. So it may be theoretical in nature, but if I could play with the numbers, the 3 months settled at 11.58 last night. The 1 month settled at 9.55. Let's just have a little fun and say that I sell 2.5 at 11.58 and buy 1 at 9.55, even if that may not be possible in the actual markets right now. And let's see what happens a week from today and how those numbers turn out.
So you heard it here first, listeners. Don has a concrete position on now in those contracts. I'd say we can bet a steak dinner as well, but you and I are not in the same neck of the woods very often, A, and B, I'm on the same side of the trade as you. I agree with that.
As I always say, Mark, in these instances, all I can be is wrong.
But listeners, an interesting one to look at, and indeed an interesting one to play with, and I like the concept of trying to determine the precise ratio, because you're right, the 3-month contract has a little more meat on its bones. It'll be a little more difficult to nudge that contract in the right direction. So
we played around with the numbers once for a presentation that we had, a PowerPoint presentation explaining the product, and it changes at different times, so it may not be precise, and I didn't work it out before the show, but it kind of has to do with how many days are already logged, how many days remain. If you had a certain volatility going forward, how would that impact the 3-month contract with respect to the 1 month? And as you mentioned, it wouldn't be as sensitive, so you need more of the 3-month. And we worked it out to about 43%, so about 2.5 times or something like that. But maybe that'll be the subject of a future commentary as to how you might do this kind of arbitrage.
Yes, I think that's definitely something worth exploring further, perhaps for a future episode. And Don, I think the hurricane is moving in on you, because we heard a little bit of your Skype fading in and out there. So perhaps it's time for you to get down to the bunker, sir. And so I think with that, we're going to close out this episode of Volatility Views. As always, I want to thank my partner in crime, Don Schlesinger from the Volatility Exchange. And Don, is there anything new or exciting or just interesting going on up at volex.us you want our listeners to know about?
Just to keep the faith, and that negotiations are going on as we speak with a couple of household names in equity, and we are trying to bring out new products, and everybody has expressed interest in VolContracts on perhaps equity indices. So yet again, as a little bit of a teaser, I hope that we can have some good news in the weeks and months ahead on that score.
Well, I look forward to being your first customer on those equity indices when and if they do arrive, sir. All right, and that's going to do it for this show. Like I said, I want to thank all of our listeners out there for downloading and streaming and subscribing to this program, both in our network feed and propelling the very, very new feed, just launched, I think, a few days ago in iTunes, and already giving it a strong subscriber base from which to draw with. So by all means, you could check out the new feed in iTunes, just search for Volatility Views, and you could find all of Don and my silliness in that show, as well as all the previous shows we've recorded. And Don, it's time for you indeed to get down to the bunker, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts or volatility trading, please visit www.voix.us. If you would like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your questions in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com, via Twitter at twitter.com/options, or facebook.com/the Volatility Exchange, and by voicemail at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments, and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VOIX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.